These trajectories represent a massive shift. Left, Micron tracks an 844% upward move. Right, over $1 million profit on AMD. The vertical break is the focus here. This isn't standard growth. It's an explosion, catching the establishment off guard. Go back just 12 months from that breakout, and the charts tell a different story. Both stocks were stagnant, trading sideways with almost no momentum. At the time, the consensus was clear. These companies were irrelevant. To the institutional analysts, AMD and Micron were stagnant assets in a sector that had already peaked. This shift was the result of a perfect storm. It was the moment a series of massive internal changes finally collided with a Wall Street community that was looking the other way. These gains represent the mathematical fallout of a massive market mismatch. The gap between the quiet progress of the companies and the loud indifference of the analysts. To understand that mismatch, we have to look at the fabrication floor. The semiconductor sector relies on physical, high-stakes manufacturing that operates far ahead of the daily ticker. While the stock price sat idle, AMD was executing a quiet engineering expansion, moving aggressively into the CPU market with the Ryzen architecture. They were scaling on two fronts. Alongside their CPU growth, AMD was pushing a parallel strategy into GPUs, expanding their reach across the hardware landscape. Micron faced a different catalyst. The global market suddenly saw a spike in demand for memory hardware, the physical RAM sticks seen here, needed for a new generation of data centers. This demand gave Micron pricing power. Because they controlled the necessary inventory, they gained the leverage to dictate prices in a market that had no other choice but to pay. By the time the stock charts started to move, the internal economic architecture of both companies had already shifted significantly toward these high-growth segments. On the other side of this collision was the institutional Wall Street analyst community. Large financial institutions often rely on trailing indicators, data about what a company did in the previous quarter, rather than real-time technological capability. This reliance on the past meant analysts were modeling outdated versions of AMD and Micron. They were tracking companies that no longer existed, missing the hardware shifts entirely. Wall Street was caught offsides. They were positioned for a market reality that had been replaced by a new cycle of engineering. The impact occurred when these companies released their updated revenue reports. The massive physical growth inside the factories finally hit the spreadsheets of the analysts. Panic set in as institutions realized their error. Traders scrambled to buy back in, trying to fix their models and secure positions before the window closed. The chaos on the floor signaled a violent realignment, a forced correction of Wall Street's perception to match the physical reality of the technology sector. When you see an 844% jump, you're seeing these two lines snapping together. It's the market correcting a massive error. The profit potential is found in the size of that gap. The larger the institutional blind spot, the more explosive the eventual correction. These moves are grounded in the hardware. This patterned silicon wafer represents the engineering dictating the market's direction, regardless of what the analysts believe. This case study highlights a recurring pattern. The pace of actual engineering often outruns the lagging models used by institutional finance to track it. Independent investors can observe these technological shifts as they happen, evaluating the hardware on the ground before trailing institutional data catches up. Historical wealth in this market isn't found by following the consensus. It is found by identifying the reality of the technology before it forces its way into Wall Street's view.